I'm Adam.
I'm Jane.
And I'm Ali, and this is our Financial Markets Market View video.
Today we'll be analysing the Australian dollar against the Japanese yen and the Australian dollar against the US dollar.
The Japanese yen is the third most traded currency in the world and it's the most traded currency in Asia. In 1973, Japan switched to a floating exchange rate, which is a type of exchange rate regime in which a currency's value is allowed to fluctuate in response to a foreign exchange market mechanisms. The Australian dollar is the fifth most traded currency in the world, and it switched to a floating exchange rate in 1983. Japan is Australia's second largest export market behind only China. Therefore, our exchange rate with Japan is influential in determining economic success within our own borders.
From the graph above, it can be observed that the Japanese yen has been fairly volatile, however, it has been steadily decreasing against the Australian dollar. In this presentation, we will be covering 3 of the 4 economic fundamentals: inflation rates, commodity prices, and interest rates.
If Australia has higher inflation than its trading partners, it will experience less demand for exports and more demand for imports. This correlates to less demand for the Australian dollar, causing a downward shift in the demand curve from D1 to D2, and more supply of the Australian dollar, causing an upward shift in the supply curve from S1 to S2, thus creating a new equilibrium exchange rate at ER2. According to the ABS, since mid-2013, Australia's core inflation rate has been gradually declining from 2.5% to 1% in July 2016. Consumer prices in Japan dropped down to negative 0.5% in July of 2016, resulting in the 5th straight month of decline in the cost of living. Japan's central bank projects slight deflation to continue in the near term, but it continues to maintain that inflation would reach a target rate of 2% year-on-year in the second half of 2017.
A high inflation rate will generally lead to a depreciation in the Australian dollar as a result of reduced demand for exports and a rise in imports, leading to a greater supply of the Australian dollar in the foreign exchange market. Therefore, countries with lower inflation rates tend to see an appreciation in the value of their currency. If Australian exports become more expensive because of inflation, overseas importers of Australian goods will turn to other countries and the value of our exports will fall, along with demand for and the value of the Australian dollar. An increase in commodity prices will increase the value of Australian exports, resulting in an appreciation of the Australian dollar due to the high demand of the Australian dollar. However, despite the following appreciation, trading partners cannot turn to other suppliers because commodity prices are constant worldwide.
It can be seen that the trends of the TWY for Australian dollar against the US dollar exchange rate and the commodity prices are extremely similar. The graph pictured on the screen right now shows a strong correlation between commodity prices and Australia's TWY weighted to reflect each trading partner's importance in the country's trade. As previously mentioned, Australia's exports consist heavily of commodities such as minerals and fuels, gold and food. On the other hand, Japan comprises of mainly secondary manufactured goods including machines, vehicles and electronic equipment.
The graph above displays how commodity prices have been falling substantially in the last few years. Japan would benefit from lower commodity prices as they require these secondary materials such as steel to produce cars. This allows them to lower their cost of production, leading to a rise in Japanese exports as a result of the new lower price. This lower price would increase demand for Japanese exports and therefore for the yen as well. Ultimately, if commodity prices fall, the value of the Japanese yen will appreciate against the Australian dollar. The traditional view is that an increase in a nation's interest rates generally leads to a rise in capital inflow, which increases demand for the currency, while at the same time discouraging capital outflow, therefore decreasing the supply of the nation's currency. There is a rise in capital inflow as more overseas investors want to take advantage of the high interest rates for a better return, and Australia is investing a greater proportion of funds in the domestic financial markets, therefore decreasing supply of the currency.
Because the banks are paying interest where they should be earning interest, it is extremely costly for the government to sustain the negative interest rate. Because of the negative interest rates, the local Japanese people have no incentive to invest in their own financial system, instead looking elsewhere. This increases the supply of the Japanese yen, causing a depreciation of the currency. Low interest rates have been encouraging domestic demand, while policymakers speculated inflation would remain quite low for some time, therefore allowing monetary policy to aid in stimulating growth, as inflation is within the target range of 2 to 3%.
By adopting negative interest rates, Japan has weakened their currency against Australia's as it encourages investors to seek higher returns elsewhere. While Australia's interest rates have been on the decline, they still remain comfortably higher than Japan's cash rate. Japan is currently experiencing deflation, meaning there is a general decrease in prices and rise in the purchasing value of money. Therefore, international consumers will demand more goods and services from Japan relative to Australia, leading to an appreciation of the Japanese yen to the Australian dollar. If commodity prices continue to spiral downwards, it will further decrease the value of Australian exports, resulting in a depreciation of the Australian dollar against the Japanese yen. This will also aid in further decreasing price levels in Japan, as the commodities are used in the production processes, helping to lower the inflation rate for a nation, furthering the depreciation of the AUD to the JPY.
A negative cash rate has deterred investors from keeping their savings in Japanese banks, instead forcing them to look elsewhere to receive positive returns on their investment on their money, such as Australia. This decreases demand for the Japanese yen and results in a depreciation against the Australian dollar. In the next 3 to 6 months, we would expect the Australian dollar to continue to depreciate against the Japanese yen, as it has done so in the past 12 months. Deflation within Japan, as well as decreasing commodity prices, will contribute to this, whilst negative inflation rates will help to slow this depreciation. As stated earlier, the Australian dollar is the 5th most traded currency in the world. According to the Department of Foreign Affairs and Trade in 2014-2015, the United States was Australia's 3rd largest two-way trading partner.
From the graph, it can be seen that the Australian dollar has been steadily increasing against the American dollar since January this year. As of the 19th September, one Australian dollar equals to 0.7544 US dollars. As stated earlier, if Australia has a higher inflation rate than its trading partners, it will experience less demand for exports and more demand for imports, as it becomes more costly to international buyers. This therefore means less demand for the Australian dollar, D1 to D2, and more supply of the Australian dollar, S1 to S2, as shown in the graph above.
This table from rate inflation shows the Australian inflation rates throughout the years to current. While Australian inflation rates have been gradually declining from 2.5 in mid-2013 to the current 1%, the United States inflation rates have slowly been doing the same from 1.5 in 2013 to the current 1.1, which can be seen in the graph on your screen now.
The American Consumer Price Index has had a slight increase from 140.6% inflation last month to 140.9% inflation since 1982, which is the base year. Comparing to previous months in 2016, this is a sign of the Consumer Price Index slowly increasing, as can be seen in the graph above. As mentioned previously, a higher inflation rate corresponds to depreciation in currency due to reduced demand for exports and rising imports, leading to a greater supply of the currency to the foreign exchange market. While lower at the moment, the Australian inflation rate over the years is generally higher than the United States. If this continues while appreciating at the moment because of lower inflation rates, Australia will soon be seeing a depreciation while the US dollar inflation rate begins to drop.
The United States is the world's 3rd largest exporter after the European Union and China, trading $4.9 trillion worth of exports with foreign countries, according to morethanshipping.com, in petroleum refining, organic chemical manufacturing, and car and automobile manufacturing. However, while commodity prices in the USA are low, Australia can take advantage of this, as the US exports will now be cheaper than purchasing them domestically within Australia. But because commodities in the US are cheaper than domestically, the USD will soon begin to appreciate as demand from foreign countries increases. At the meeting on the 6th of September, Glenn Stevens, the Australian Governor of Monetary Policy, released a statement saying that the board has decided to leave the Australian cash rate unchanged from the last meeting at 1.5%. He states that while several economies have recorded improvement over the past year, conditions have become more difficult for a number of market economies. The United States Central Bank has introduced a target range for interest rates to stay between 0.25 and 0.5%.
Because the interest rates in the United States remain low at 0.50%, where Australia's interest rate is higher at 1.5%, investors will choose to invest funds with Australia instead, as they will enjoy more of a return on their money in leaving it in Australian banks compared to if they would leave it in a United States banks. In conclusion, while competing strongly with the United States at the moment in terms of interest rates and inflation rates, we believe that the AUD will start to appreciate against the USD over the next 3 to 4 months before the USD will overtake yet again and the AUD will depreciate against the USD. Thank you for watching our presentation. We hope you enjoy.